Wall Street, August the 1st, 2012. On the morning of the 1st of August 2012, everything seemed absolutely normal. There were no signs that an economic crisis was about to surface, no alarming headlines, nor any indication that something unusual was about to happen. It was just another ordinary morning on Wall Street, with the same daily routine quietly repeating itself inside offices, data centers, and trading rooms. It was 9:30 a.m. when the bell of the New York Stock Exchange rang, marking the start of trading. Millions of transactions began to take place, processed by a system invisible to the public, and in a fateful instant, something began to slip out of place. At first, it went unnoticed by the public. Some stocks were moving slightly faster than usual. There were small fluctuations, but nothing that raised concern. Modern markets are inherently volatile, and this frequent instability is part of the game. However, that morning, as time passed, the movements began to make less and less sense. Stocks known for their stability started rising and falling abruptly, without any news to justify such variations. Experienced operators, accustomed to identifying patterns, began to suspect that this was not a market reaction, but rather an error. Meanwhile, inside Knight Capital Group, one of the largest automated trading firms in the United States, the first alarm signals began almost immediately after the market opened. To much of the financial world, Knight operated quietly in the background, yet it was one of the pillars supporting market liquidity. Founded in 1995, the company acted as a market maker, not typical traders. They did not speculate on trends or directional bets. Their role was to buy and sell simultaneously, ensuring there was always someone on the other side of a trade. By 2012, roughly 10% of all U.S. equity trades passed through its systems. Billions of dollars were processed daily by algorithms, executing thousands of orders per second with near-perfect precision. Most of the time, these systems functioned flawlessly, but that morning something appeared to have broken that balance. Screens began showing unusual volumes. Orders appeared and disappeared too quickly for any human analysis, and in that world, speed meant survival. The firm was buying stocks at extremely high prices and seconds later selling those same stocks for far less. The cycle repeated automatically, relentlessly. Within minutes, it became clear this was not merely a bad trading day. It was uncontrolled behavior caused by a malfunction. The origin of the problem did not lie in that moment, nor even that day. It had existed for weeks. In July 2012, the New York Stock Exchange announced the implementation of a new system called the Retail Liquidity Program. The goal was to adjust how certain retail investor orders would be handled, encouraging greater market liquidity. For firms like Knight Capital, this meant modifying their trading systems on a tight schedule, 3 weeks to develop, test, and deploy new code. The pressure was evident, though not unprecedented. The technical team worked under pressure as they had many times before. Code was written, tests were conducted, and deployment was scheduled. At first glance, everything seemed compliant. What no one noticed was what already existed inside the system. Like many companies with aging infrastructure, Knight had accumulated layers of legacy code functions, written years earlier by teams no longer at the company. Segments created for temporary testing, simulations, or experiments had lost their original purpose but were never removed. One of those segments was an algorithm called PowerPeg. It had been developed years earlier for internal testing and was never meant to run in a live environment. When it was no longer needed, it was deactivated but remained stored in the system. There was no clear documentation explaining its existence, no automated warning, no visible risk indicator. The code simply remained there inactive, forgotten, and unmonitored. During the implementation of the exchange's new system, engineers needed to use an internal identifier, a digital marker, instructing the system how to handle certain orders. Unknowingly, they reused the same identifier that had once activated PowerPeg. 7 of Knight Capital's 8 servers received the full update. 1 did not. No error was recorded. No alarm was triggered. The infrastructure appeared to function normally. But on that specific server, PowerPeg still existed, and now it had a trigger again. When the market opened at 9:30 a.m., orders began arriving at Knight's servers. 7 processed everything correctly. The 8th interpreted the signal as an instruction to activate PowerPeg. Within seconds, the algorithm began operating. It started buying stocks at elevated prices, selling them moments later at lower prices, and repeating the cycle thousands of times per second. There were no configured risk limits, no price verification, no automatic mechanism capable of stopping the process when abnormal losses occurred. The algorithm had no awareness of the damage it was causing. It simply executed. Outside, at trading desks across Wall Street, the behavior began drawing attention. Stable stocks showed extreme movements. Some jumped several dollars in seconds. Others plunged without explanation. Some traders tried to understand what was happening. Others quickly realized someone was buying high and selling low and took advantage. The market did not know the source of the problem, but it reacted in real time. Inside Knight Capital, the first minutes were marked by confusion. Screens displayed volumes far outside historical norms. Orders arrived too quickly for manual analysis. Attempts to halt operations faced a cruel paradox. The systems had been designed not to stop. Stopping meant losing opportunities. Stopping meant failure. Safety protocols intended to prevent accidental shutdowns made rapid intervention extremely difficult. While engineers analyzed logs and tried to identify the problem's origin, the algorithm kept trading. Millions of dollars were lost every minute. Only at 9:47 a.m. was the responsible server identified. 17 minutes had passed since the market opened. Even after identification, shutdown took additional minutes due to internal procedures and authorization layers. At 9:58 a.m., 28 minutes after trading began, the server was finally disconnected. The flow of orders stopped. Silence returned to the screens, but the damage was done. In the following hours, Knight Capital tried to grasp the scale of the disaster. The numbers seemed unreal. In less than 45 minutes, approximately 4 million trades had been executed across about 150 different stocks. Firm accumulated unwanted positions valued at roughly $7 billion. As those positions were unwound throughout the day, the final loss became clear: $440 million. For comparison, Knight Capital's market value was about $365 million. In under an hour, the company had lost more money than it was worth. Client confidence evaporated almost instantly. The firm's survival was measured in hours, not days. Over the weekend, intense closed-door negotiations took place. Banks, investors, and competitors assessed risks and opportunities. The following Monday, a deal was announced. A group of investors injected $400 million into Knight Capital in exchange for 73% control of the company. Original shareholders were largely wiped out. Knight would continue to exist, but not as before. Months later, it ceased to exist as an independent company. Subsequent investigations revealed a chain of critical failures: undocumented legacy code, insufficient testing, incomplete software deployment, and absence of automated risk controls. None alone would likely have caused such a disaster. Together they did. The U.S. Securities and Exchange Commission fined the company $12 million, symbolic compared to the losses, but a clear signal that software errors at that level were not merely technical problems. The Knight Capital collapse became required study in engineering, finance, and risk management programs worldwide. Not because it involved fraud or criminal intent, but because it exposed an uncomfortable truth about modern systems. When machines operate faster than human reaction time, small errors do not stay small. They escalate, they accumulate, they explode. Today, billions of transactions continue to be executed automatically every day. Most occur without incident, but the Knight Capital case remains a quiet warning. Somewhere, in some critical system, there may be an old, forgotten piece of code waiting for the wrong signal. And when that signal arrives, sometimes 45 minutes are all it takes. After that day, nothing returned exactly to normal. Although markets absorbed the shock relatively quickly, confidence did not recover at the same pace. For many, something previously invisible had been revealed, not a new risk, but one that had always existed, now made explicit. Inside Knight Capital, the atmosphere was one of silent devastation. There were no celebrations or public speeches, only internal meetings, technical reports, and meticulous reconstruction of events. Every line of code was examined like forensic evidence. Decisions made weeks earlier were revisited to prevent recurrence at any cost. Engineers directly involved in deployment reported no negligence or rush. The issue was not someone doing something wrong, but a system allowing something wrong to be possible. The absence of a single check, limit, or emergency stop turned an operational fault into a systemic event. PowerPeg, that forgotten code, became the perfect symbol of the collapse, not because it was sophisticated, but because it was simple, direct, and dangerous. It did not evaluate context, impact, or consequences. It executed, and in an environment where execution equals profit, no one had asked what would happen if execution occurred outside its intended context. This exposed a deeper issue: absolute dependence on systems no one fully understood anymore. Over the years, Knight's infrastructure had been modified, expanded, adapted, and patched repeatedly. People came and went, but the code remained. Eventually, full system comprehension disappeared, leaving interconnected parts that worked until they interacted unexpectedly. The market responded pragmatically. There was no collective pause for reflection, no structural halt to automated trading. Instead, confidence was redistributed. Firms began questioning internal controls. Managers demanded deeper audits. Regulators asked more precise questions, not about intent, but about architecture. The SEC made it clear the case was not isolated, but an extreme example of industry-wide risk. Complex systems operating at extreme speed, invisible interdependencies, minimal error margins. The fine was not about compensation, but precedent. The message was clear. Software failures in that context were no longer ordinary technical issues. They had direct market stability implications, with consequences far beyond a single company. In subsequent years, changes emerged. Automatic loss limits became stricter. Deployment testing grew more extensive. Emergency shutdown procedures were simplified precisely to avoid what Knight faced. Systems so protected against failure they could not stop when failing. Still, risk was never eliminated, only redesigned. The Knight Capital episode became a recurring reference in discussions about automation, algorithmic intelligence, and financial market speed. Not as historical curiosity, but as a persistent reminder. Presentations often concluded with a simple question: what if this happened here? It is uncomfortable because it lacks a definitive answer. No complex system is completely safe. The more efficient it becomes, the more dependent it is on internal logic. The less human intervention exists, the smaller the reaction capacity when something unexpected occurs. Knight Capital's collapse was not caused by extreme greed, fraud, or risky market bets. It was caused by excessive trust in a system that worked too well to be questioned, one that operated too fast to be stopped in time. For a few minutes, it did exactly what it was programmed to do, just in the wrong context. Perhaps that is the most unsettling lesson. In an increasingly automated world, the greatest risks do not come from wrong decisions, but from correct decisions executed without supervision. Not from poorly written code, but from forgotten code. Not from extraordinary events, but from the quiet combination of small failures exceeding containment limits. 45 minutes were enough to erase a company built over nearly 2 decades. 45 minutes showed that in modern markets, human time no longer dictates the pace. Machines decide, execute, and err on scales beyond traditional reaction. And as billions of transactions continue flowing daily at ever-increasing speed, the Knight Capital story remains a lasting warning, not dramatic, but cold and factual. In complex systems, intention does not matter, architecture does. It is not the error that frightens, it is how fast it spreads. And sometimes all that separates stability from collapse is a single reused identifier.